Hey warriors, I hope you're all doing great. This is your friend CA Rahul Agarwal and I'm here reporting to all my CA final friends who are appearing for the upcoming exams of May 26, September 26 and Jan 2027 examinations. Now, for all those people who wrote Jan 26 examinations and are still awaiting results, you are a little unclear on how your performance has been, and so probably this video is for you to watch but maybe a little later. Now, what am I talking about? This is basically your amendments video. The amendments video which now will capture all the amendments which you have for your assessment year 26-27, basically all the students who are appearing for May 26 examinations and forward. Now, Rahul, for those who have done May 26, September 26 and Jan 27, if you have done it from a faculty or you have done the ICI study material, you have already gone through these amendments. But this video is still important for you. Maybe this video will help you quickly revise on whatever is the amendments that are applicable to you so that you can have this document handy, and when you go for your examinations, probably spending another 5 minutes of it could get you an additional 10 marks in examinations. As you all are aware, since DT amends very frequently, ICI generally has a practice to check questions from amendments very often. Right? So this video is going to be basically helping you understand what are the critical amendments that you had in your examinations and how you should be paying attention to those, what kind of questions can be drafted from them, and how you should be tackling those. That is what we're going to be discussing in this video, people. So please stay with me till the very last, and I'm sure you'll learn something new and something exciting for your examinations going forward. Shall we take this video forward? Yes. Now, I have taken some efforts and I've taken off all the amendments that are applicable from each chapter, and I've put it into one PDF document so that it becomes easier for you to refer on a day of examinations and you don't have to buy my material if you don't have it already. So this material PDF will be available in the description box. Please feel free to go back and download it from the description box and use it for your personal reference so that you can do a proper job on this. This material has been designed to be about, I guess, 14 sites. Now, why is this 14 sites? Is there so many amendments? No. Technically no, but what I've done is when I gave you some amendments, people, it was also important for me to also capture the other things relating to it, right? If I just give you the amendment relating to the topic, probably you'll not understand it so much. I would have to then put the full clipping of the document so that it makes more easier sense. And so what I've done is, if there is an amendment only on one topic, I would have still captured everything else so that it's easier for you to correlate and relate to what is happening in your books. So when you have your books in handy, you can look at this document, try to match it with your book as well, and see where you have to incorporate this amendment if you are still using Jan 2026 materials. Now, Rahul, should I be switching over to May 26 materials? Do you recommend doing that? Unfortunately, yes. For a subject of direct access, while I don't deny you can definitely use your Jan 26 materials with the amendment sheet, it is a little comprehending. Yes, it can get complicated at certain point of time. Why? Because of the reason that last year there were things a little ugly. For example, when you go to capital gains had before 23rd July rules, after 23rd July rules and all. Those things can get extremely confusing and you do not have to read those for your examinations. When you don't have a topic relating to your examinations to read, reading it unnecessary along with amendments is only going to confuse you. So my small recommendation to all of you, especially for a subject like direct access at finals, is important that you buy a new material. You can obviously buy a new material, take your previous material, quickly make those markings as well so that you can always feel like the material is already used to you. But still, it is recommended that you always have a new material in your hand for you to prepare for your examinations better. Yeah. On that note, people, is what we're going to do this amendment session. Let's do it together. Let's see if you're able to relate it. If you've already gone through the amendments, let's see if you're able to recollect all the amendments that I've given to you. All amendments, like we discussed, is going to be highlighted in green, same as my material. So we've just taken the clipping of the material and we are going to give it to you for free. Shall we do that together? Yes? Chalo, let's go forward. First things, people, very obviously, since you're moving from Jan 26 to May 26, the first and the most important rule that you have to keep in mind is that when it comes to your May 26 examinations and forward, your assessment year is going to change. Now, your assessment year is going to be previous year 25-26 with an assessment year 26-27, which means all amendments as per Finance Act 2025 are going to be applying to you. Yes, so please get away from the fact that you have to read assessment year 25-26 anymore. It is assessment year 26-27 for you. Now, if you have understood the amendments, people, the first thing which is there is your rates of taxes. In rates of taxes, there are not significant amendments from a company perspective. The one amendment which is there from a company perspective is a standard thing which rolls over every year, that from a domestic company perspective, if you are going for older tax regime, then you need to check for the 25% or 30% rule. How does it happen? If you remember from our classes, people, what we do is, if you are writing examination for previous year 25-26, ignore 25-26, ignore 24-25, go 1 year before. which means for your examinations, now the latest year is going to be 23-24 financial year. 23-24 financial year turnover should be less than or equal to 400 crores, making your tax liability as 25%. Yes, so what is it, people? For your examinations of 25-26, ignore 25-26, ignore 24-25, go to 23-24. 23-24 previous year with a turnover of up to 400 crores will make you liable for a tax rate of 25%. Now, one question which may come up in examination is, what if, Rahul, I am not incorporated in 23-24 itself? What if I am incorporated, let's say, on 1st April 24, which is after the previous year 23-24? In that case, what will you do? ICAI has a recommendation that those kind of people who are after 1st April 24 will not be applying 25%, but would rather go to the 30% model. Yes, which means if you are incorporating after 23-24, ICAI's recommendation is to go for 30%. If you get an MCQ question around it, be very, very careful. Yes, so 23-24 turnover less than or equal to 400 crores, we are going for 25%. After that, we are going for 30%. That is what the criteria is. I hope this makes sense to everyone of you. Yes, yes, amazing. Now, the next and the most critical amendment which has come in your CA final examinations are actually CA interrelated syllabus, but is important for you because of the chapter which you have called as DTR, Double Taxation Avoidance Agreement. Your Double Taxation Avoidance Agreement is going to take this chapter into very critical note, and therefore you have to keep this in mind. What are we talking about? We're talking about the latest amendment of section 115 BSc. Current year 115 BSc rates have changed significantly, where you were earlier reading 0 to 3 lakhs, 3 to 7 lakhs and all that stuff. ICAI has taken the note from income tax. Income tax has made it extremely clear. Let's make life simpler. Now, the DTR rates come and say that for every incremental 4 lakhs, we'll go for an incremental 5%. So what are the rates for me quickly, people? 0 to 4 lakhs is 0. 4 lakhs to 8 lakhs is 5%. 8 lakhs to 12 lakhs is going to be 10%. 12 lakhs to 16 lakhs is going to be 15%. 16 lakhs to 20 lakhs is going to be 20%. 20 lakhs to 24 lakhs is going to be 25%. And after 24 lakhs, everything is going to hit at 30%. Yes. What are we doing once again? It is 0 to 4 lakhs 0, 4 lakhs to 8 lakhs 5%, 8 lakhs to 12 lakhs 10%, 12 to 16 is going to be 15%, 16 to 20 is going to be 20%, 20 to 24 is going to be 25%, and everything after 24 is going to be 30%. Yes, the shortcut method also works, people, which means for all these numbers up to 24 lakhs, your tax liability is going to be 3 lakh rupees. If you can check for me also. Yes, which means for the first one, what are we going to do? First one is going to be 0. Next, 4 lakhs per 5%. What is going to be the answer, people? 4 lakhs per 5% is going to give you 20,000 rupees. Next one is going to be 40,000 rupees. Next one is going to be 60,000 rupees. Next one is going to be 80,000 rupees. And the last one is going to be 1 lakh rupee. If you total all the numbers, what is going to happen? 1 lakh 80, 2 lakh 40, 2 lakh 80 and 3 lakh rupees. So the shortcut for you remains the same, which means for the first 24 lakh rupees, you're going to tax at the rate of 3 lakh rupees. The incremental can be taxed at 30%. That's the shortcut for you to keep in mind. Correct? Yes. Now, I don't have to tell you this. When it comes to DTR rules, DTR only applies on slab rate incomes, which means if you have any special incomes, that will continue to be taxed at special rates. No changes in that. Keep that change as it is. Yes. So we are only going to change on your default tax regime, slab rate concept. Clear enough to go? Yes, good. The next and the most critical amendment, while I don't expect this at CA final level, but still for you to keep in mind, is the change in the rebate model. Yes, because last year, we had only up to 7 lakhs. This time, income tax decided when we're changing the slab significantly, the numbers should also change significantly. So the rule now comes and says, if your total income is up to 12 lakh rupees under DTR, you will be eligible for rebate scheme. What is the rule? Up to 12 lakh rupees, you'll be eligible for rebate scheme. Now, if you notice, people, up to 12 lakhs, what's going to happen? For the first 0 to 4 lakhs, I'm going to tax at 0. 4 lakhs to 8 lakhs is going to be 20,000. 8 lakhs to 12 lakhs is going to be 40,000. If you total the number is coming as 60,000 rupees. So which means income tax now says for a person who's having a total income up to 12 lakh rupees, the rebate is going to be 60,000 rupees. Simple, straightforward. Yes, let's keep that in mind. So what are the rules, people? Incremental 4 lakhs per 5%, rebate is going to be 12 lakh rupees per 60,000 rupees ka rebate. Yes, the most important amendment which has come up is the change in the rebate rules. As much as you are aware about it, people, until last year, the rule was that when you want to claim rebate, you cannot claim rebate on only 112A incomes. 112A was the only income on which you could not claim rebate. Everything else was eligible for rebate, whether you were in old regime or new regime. due to some mishaps which happened in the market on a practical level, it was so decided that Nirmala ma'am has decided that when it comes to default tax regime, the section 115 BAC, you will not get rebate on any special incomes. The most important amendment says any incomes taxable at special rates are now not eligible for rebates. So you have to keep this in mind, which means the rules are now like this. If you are under old tax regime, the rules of 0 to 2 lakh 50, 2 lakh 50 to 5 lakh, 5 lakh to 10 lakh will apply. Rebate will be 5 lakhs pay 12,500. Rebate you can claim on any income except for 112A. But if you are going for 115 BAC default tax regime, then the rules are incremental 4 lakhs pay 5%. Rebate will be given for 12 lakhs tak 60,000 rupees, but this number will only be given for your normal tax regime. Normal tax regime means ignoring everything which is special taxed. That things will not be eligible for any more of the rebate. Your 115 BAC is only going to be given on your slab rate incomes. Yes, how does this work, people? Let's do a quick summary and you'll understand this. I'm giving you a scenario, people. The scenario is like this. Situation comes and says you're required to compute the tax liability of a person called Mr. Garib. Garib is going to give you incomes under both the regimes. Incomes are as follows. If he is going for old tax regime, the optional tax regime, the income has come to 2,70,000 for PGBP, 20,000 for 111A, 30,000 for 112 and 1,60,000 for 112A. If you can total this for me, people, what will happen? I will get 2,70,000 plus 20 is 2,90,000, 3,20,000, 3,80,000, 4,80,000 rupees is my total income. Check karo. I'm in old tax regime. Old tax regime says if your income is up to 5 lakh rupees, you can claim a rebate. 4,80,000 makes me eligible for rebate. Coming to the right side. The right side says my income is 4,20,000, 4,40,000, 4,70,000, 5,30,000 and then 6,30,000. Yes. 4,40,000, 4,70,000, 5,30,000, 6,30,000. People in new tax regime, what can we do? We can claim rebate up to 12 lakh rupees. Now this is 6,30,000 only, which means this is also eligible for rebate. Here is where the problem starts. Now because I'm in old tax regime, I'll have to look at the incomes. Look at the incomes. PGBP pay, can you claim rebate? Answer is yes. 111A pay, can you claim rebate? Answer is yes. 112 pay, can you claim rebate? Answer is yes. But 112A pay, can you claim rebate? Answer is no. So no on the rebate on the last income alone. Coming to default tax regime. Default tax regime, can you claim rebate on PGBP? Answer is yes. Can you claim rebate on 111A? No. Can you claim rebate on 112? No. Can you claim rebate on 112A? Again, no. This is how the scheme is going to work. Yes. Now quickly help me out with the rates, people. The only reason I've given this example to you is because there is a change. You are already aware about the change after 23rd July. So you have to keep that in mind. So for that reason, I'm giving you this example, people. After the 23rd July scheme has got over, now that you are in financial year 25-26, capital gains has a standard rate. Standard rate says me what, my friends? My standard rate says when I am in 111A, my tax is going to be at the rate of 20%. When I'm in 112, my tax is going to be at the rate of 12.5%. When I'm going to 112A, my tax is going to be 12.5% in excess of 1 lakh rupees. In excess of 1,25,000 rupees. This is also changed, right? In excess of 1,25,000 rupees. Yes, so rates are now given to you, which means these are the only rates you're going to use for your attempt of May 26 and forward. They don't have the older rates. Don't worry about those older rates. Let's now talk about the tax rates. PGBP, what we'll do, people? We will do slab 2,70,000. What we'll do for the first 2,50,000, we will tax at nothing. After that, 20,000 will be taxed for 5%, which means the answer gives me 1,000 rupees. Next, 112A pay 20%, 4,000 rupees. 112 pay 12.5%, which comes to 3,750. 112A pay remove 1,25,000, then tax at the rate of 12.5. Answer came to 4,375. I am eligible for a tax. I am liable for a tax of 13,125. Now, at this stage, what did I tell you? When you have a tax of 13,125 and you are eligible to claim for rebate, old tax regime says ignore 112A alone. So, which means I'm going to ignore 112A incomes and I'm only going to take these three into consideration. Look at these three. 1,000 plus 4,000 is 5,000 plus 3,750 is 8,750, which means only 8,750 ka rebate I was eligible for, making my tax liability of 4,375 with the cess of 4,550. I hope this made sense to you. Yes, but when you go to new tax regime, what does new tax regime say? Compute the PGBP for 1 lakh rupee. 111A goes 4,500, 4,000, 3,750, 4,3,730. I am getting 13,125. But in this 13,125, what can I claim rebate on? I can only claim rebate on the 1,000 rupees. I cannot claim rebate on anything else, which means only 1,000 has been carried forward for rebate purposes, making my tax liability as 12,125 with the cess of 12,610 is the final answer. Yes, which means now, even though default tax regime may give you better tax rates, it may be possible that you would still opt for old tax regime provided you're having special incomes. You're having special incomes. Clear enough to go? Yes, be very, very careful on this as an adjustment of people. I don't expect this to come at CA final level because it's a CA inter syllabus, but still, nevertheless, just be careful about it. Yes, with this concept coming in, the one thing which you obviously have to keep in mind is what is called marginal rebate, because your rebate has now changed to 12 lakh rupees by 60,000 rupees. Marginal rebate will also change accordingly. So now I come and check that if you have a marginal rebate conversation, that will probably happen if your income is up to 12 lakh 60,000 rupees. Yes, now it's a little bit more than 12 lakh 60. Obviously, it's 12 lakh 60 to something, but just for the convenience sakes, ICAI is not going to go and ask you those kind of specific information. My point is very simple. If you are under default tax regime and you see your income statement up to 12 lakh 60,000 rupees, watch out for marginal rebate. Yes, watch out for marginal rebate. How do we do marginal rebate, people? Straightforward. If your income is 12 lakh 60,000, you know that up to 12 lakh rupees, you're not going to pay tax because you're eligible for rebate. So on the extra 60,000, you're simply going to surrender it off. So you'll go to income tax department and say, sir, because I'm not going to have any kind of income tax up to 12 lakh rupees, the extra 60,000 is what I would like to surrender to you. With the cess on it, I will give you the tax liability. I will give you the tax liability, simple, straightforward. So if I give you an example, people, imagine my income is 12 lakh 15,000. What will I say? Sir, up to 12 lakh rupees, I was anyway not liable for tax. 15,000 is causing me troubles. So you keep the 15,000 in your hand. I don't need the tax on it. So 15,000 I will fully surrender to you. So I'm going to surrender 15,000 rupees to you. Add your cess on it and give me the tax liability as 15,600 rupees. Straightforward. 15,600 rupees. Clear enough to go? Yes or no? Yes, this is what your tax rates looks like. I hope this made sense to every one of you. Great. Amazing. Let's proceed forward on to the computational models, people. The computational model starts with PGBP. Now, there are no amendments significantly when it comes to any of your heads of income, but PGBP has a small amendment, not from income tax perspective, but from a different chapter. For those who know, people, we have this chapter section called as 43B. 43B basically comes and says that if you are going to make any kind of payment to micro and small enterprise, this payment has to be made within the due dates. The due dates being what you agreed with the person, or 45 days in case of written agreement, whichever is earlier. If it is oral, then it's automatically assumed as 15 days ka payment date. Yes, so income tax is now coming and telling you that if you don't make the payment within 45 days or your expected time limit, whichever is earlier, or 15 days in case of oral agreement, whatever payments you're supposed to make to micro and small enterprise will now get disallowed. It will get disallowed and will be allowed in the year on which you actually make the payments of. Yes, now the problem which came up is, people, what is micro enterprise, what is small enterprise is not part of your syllabus. It's part of MSME Act. Yes, so therefore you don't need to read this per se. But what I've been noticing is that ICAI has been putting this as a part of your syllabus as well, and therefore unfortunately it is important for you to keep the numbers in mind. Now, is that a significant number and you need to be worried about it? Answer is no. It's a very straightforward number, people. You'll notice that when it comes to micro enterprise and small enterprise, MSME Act comes and says the rules is very simple. I will check for two things. One is your investment in plant and machinery. The other is your turnover. What am I checking? Investment in plant and machinery and your turnover. Income tax, MSME Act comes and says, if your investment is less than or equal to 2.5 crores and your turnover is less than or equal to 10 crores, I will now call you a micro enterprise. What is it? 2.5 crores for investment and 10 crores for turnover. I will call you micro enterprise. But if you are going to be a small enterprise, just do 10x of both. Yes, just do 10x of both, which means your 2.5 crores will become 25 crores and your 10 crores will become 100 crores, which means small enterprise is now going to become 25 crores and 100 crores. These are the parties that you have to keep in mind for your computational module. Now, technically, whether you call the person as micro enterprise or medium or small enterprise, it doesn't really matter. Yes, so which means I can simply come and tell you from an exam perspective, the only thing you have to keep in mind is this one. If you can understand the small enterprise properly, you can write your examinations, which means in examination, one thing you have to keep in mind is if your turnover is less than 100 crores and your plant machinery equipment is less than 25 crores, you can call that entity as being covered under 43B and the payments has to be satisfied accordingly. Anyone who does not satisfy these conditions will probably become medium enterprise or will probably become another normal enterprise, and therefore for them 43B is anyway not going to apply. So you don't need to mug up the fact that there is something called micro enterprise and small enterprise. All that you have to keep in mind is that my turnover should be less than or equal to 100 crores and my investment should be less than or equal to 25 crores. If you can keep that in mind, then you're already done for 43B. You don't need to read anything else. Clear enough to go? Yes. Again, I don't expect questions on this, but looking at Jan 26 examinations, ICS tried to play around with this. While they did not really test you on micro and small enterprise, they still gave you numbers here. So I don't want you to get confused in examinations. Keep this in mind. 100 crores, 25 crores. Yes. By the way, people, notice it's an and condition. It means both the conditions have to be satisfied for you to be achieving a small enterprise status. If any one of these things gets breached off, then you're no more a small enterprise. You will move to the next category. Clear? Good. After PGBP, people, capital gains has very small amendments. Amendment number 1 is that they come and clarify when it comes to capital assets, any kind of securities which going to be held by FIIs, which were going to be held as FIIs until last year was always considered as capital asset, even if you were in the business of trading in securities. This year has made an amendment where they've come and clarified, I am now going to also cover any investment funds which is registered as per IFSC regulations. Yes, so it's a very simple small amendment, will not be tested in exam, that's my guarantee to you, so don't worry about it. I'm just giving it to you because it's notified. Yes, so the amendment says if you are going to have any kind of FIIs or investment funds, then you will be covered under capital asset definition. You don't need to be taxing it under PGBP rule, so don't worry about it. Yes, good. Next one says your ULIPs. For those who remember, people, there is a section called section 45(1)(b) which talks about ULIPs, which says that if you are going to have any unit linked insurance plans, you should not make a premium more than 2,50,000 rupees. If you're going to make a premium more than 2,50,000 rupees, the policy or the group of policies will become taxable. Now, there was this one confusion which was going on in the market. For those who know, people, under ATC, there is an additional condition. ATC basically comes and says that when I'm going to invest in an insurance policy, I should not make a premium payment more than 20% if the policy was taken before 2012, 15% if the policy was taken after 2013 for a handicapped person, and 10% if I took the policy for normal citizen after 2012. The confusion was that section 1010D came and clarified that if you take a policy which is having the premiums more than that, ATC is not the only problem. The policy will also be taxable. The policy will also be taxable. And therefore, there was this huge confusion in the market as to how will the policy be taxable or where will the policy be taxable. Now, you may come and ask, Rahul, what stupid question is this? Obviously, it is going to be taxable under IFOS. But hey, understand, we're talking about ULIPs here. ULIPs has traditionally been under capital gains. So income tax has made this clear distinction that ULIPs taxation should be under capital gains and LIP taxation should be under IFOS. Now, the confusion was that if I have a ULIP on which I pay a premium more than 2,50,000, you said capital gains. But if I paid a premium less than 2,50,000 and still my premium is more than 10%, the confusion was that it was going under IFOS. To tackle that confusion, this year has come and clarified saying to you, every ULIP taxability will only happen under capital gains, which means even if you pay a premium less than 2,50,000, but the premium is more than 10% or 15% or 20% as per your ATC conditions, then that ULIP also will now be taxable under capital gains, will not be taxable under IFOS. So it's a very small amendment, people, which comes and clarifies where a person is receiving any amount from ULIPs, they are now going to be taxable under the head capital gains, even on the condition that their premium exceeds the 20, 10 and 15% rule. Now, the 2,50,000 was always there, but this is an additional condition, which means this has now been moved from IFOS to capital gains in your syllabus. Clear? Yes, never been tested, people, not very critical, but still important for you to keep in mind. Next is a very small amendment, people, which comes to 222E. Yes. Yes. Sorry. Yes, your amendment under IFOS chapter, people. The weather is changing. Sorry. Yes, so the amendment which is coming under IFOS, people, which is the taxation of dividends. As you all are aware, there is a very important section which is coming from exam perspective almost always, something called a section 222E. Section 222E was basically the fact that if you are closely held company going to give any kind of advance and loans to your shareholder holding more than 10% substantial interest, then in that case, whatever loan you gave to them would be treated as dividends in the hands of the shareholder. That was a topic that you're already aware about it, people. In this, there has come a very industry specific amendment, not very critical in examinations. You can choose to let go, but I'm just reading it out for you. The amendment comes and clarifies that where the loans and advances is between a group entity which is registered in IFSC as a finance company or a finance unit which is set up as a global or regional treasury center for undertaking treasury activities, and its parent and principal entity is listed on a stock exchange outside India, then in that case you will not attract the provisions of deemed dividend. Which means if I am a treasury center in India, IFSC center, and I'm going to give it to my parent company sitting outside India, I will not be treating it as an section 222E dividend anymore. It will not be taxable. Now, industry specific issues like these are never tested in examinations. Frankly speaking, if you see the word IFSC itself, it's always exempt in income tax. Yes, you don't need to read too much about it, but nevertheless, keep this in mind. Yes. Next comes your TDS obligations. Now, people, major amendments when it comes to your examinations have come in TDS in this year, so therefore TDS is extremely critical. The first amendment which you have to keep in mind is when it comes to TDS, section 194, which deals with dividends, has now come and clarified that now dividends for an individual will not be taxable if the dividend limit does not crosses 10,000 rupees. Earlier this number was different, now the number is different. Now the TDS limit is 10,000 rupees, which means up to 10,000 rupees when you give dividends to an individual, they will not be deducting TDS the moment the payment is made other than by cash. If you're going to make the payment in cash, every rupee was liable for TDS, but if you're going to make a payment other than by cash for an individual alone, you will not deduct TDS up to 10,000 rupees right now. After 10,000, yes, you will continue to deduct TDS at the rate of 10%. That is the change which has happened. The same changes come in mutual funds as well, people. In mutual funds also, any kind of dividends or income coming from mutual funds will not be liable for TDS up to 10,000 rupees. That is what the conversation is. Yes, small amendments when it comes to TDS, very, very critical for your examination perspective. Clear? Perfect. Let's proceed on forward, people. The next chapter is chapter number 15, which is a set off and carry forward of losses. This time's chapter has a very small amendment, but yes, a very, very important amendment from exam perspective. Do expect questions on this in examination. The amendment relating to your business reorganizations. For those who remember, people, until last year, there was a conversation which said that when you do amalgamation or business conversions, if you do any kind of amalgamation or conversion, and if all conditions have been properly satisfied, then whatever losses you had under the amalgamation or the business conversion was taken over by the new entity for a fresh period of 8 years. Yes, so they used to come and tell me that if you are going to have any PGPP loss in your amalgamating company, the amalgamated company will take it over for a fresh period of 8 years. When you convert your private company, company to LLP and all, then the PGBP will be carried forward for a fresh period of 8 years. In the market, the issue started on this because people were losing losses. What they would do is in the year 7 and all, they will start conversion rules, and therefore people were now unnecessarily carrying forward losses which they could not do. To tackle that issue has come in an amendment which comes and now clarifies that if you're going to undertake any kind of amalgamation on or after 1st April 25 or any kind of conversion after 1st April 25, then if your conditions are getting satisfied, the new entity cannot carry forward it for a fresh period of 8 years, but can only carry it forward for the remaining period in the 8 years. What does remaining period mean? If my amalgamating company had it for 4 years, the new company will now carry forward for the balance 4 years only. If the amalgamating company had it for 8 years, the new company does not get any more losses to set off. They have to waste the losses. They have to exhaust the losses. That is what the conditions are. Yes. So a simple small amendment, people, where they've come and clarified that you cannot carry forward the losses any more than 8 years overall itself. Both entities put together cannot carry it forward for more a period of 8 years. This is an amendment for the current year, and I do expect a theory question around it. So you may get a business reorganization question, and one small side note may come in the question where they may come and say, how many years can the new entity carry it forward for? You have to simply come and say they'll carry it forward for the balance period which is available, not for the fresh period. A very critical amendment for you to keep in mind. Don't get confused in examinations. Always have this in mind properly. Clear? Yes? Good. Small amendments, people. Nothing great about it. Moving on to Chapter 6, reduction, a very small amendment which did not come by Finance Act 25, but they later on had to bring in an amendment law for it. The amendment under 80CCD, again, not critical at all at CA final level. You can choose to skip it off, will not be tested in examinations, but nevertheless, the amendment basically comes and clarifies that if you are in NPS scheme, what is the rules if you remember, people? NPS scheme comes and says when an employee self-contribution does, then in that case, for the first 50,000, there will be no issues. You will be completely given a deduction, and anything excess of that 50,000 rupees will be allowed as deduction only up to 10% of salary. Yes, understand this is only under your old tax regime, it's not under the new tax regime. Amendment of the current year comes and says you can now claim contribution of NPS deduction not just for yourself but for your minor as well. but for your minor as well, which means now they come and clarified you can also contribute money on behalf of your minor and you will get the deduction in your hands, which means now when you contribute money for your minor, you will get the deduction under 80CCD. Again, old tax regime rules. I don't think this will be tested at CA final level people, because your individual taxation only comes under DTAA, and DTAA mein these kind of questions are remote enough to expect, so you don't get an amendment in this. Yes. Good. The critical amendments, what you have to keep in mind, people, is coming under now. Your final level chapters are starting right now, which is your NPO chapter. Your non-profit organization chapter basically has a very, very small amendment relating to your timelines of renewals. Yes, for those who know, people, that when you go to your registration for NPOs, you only get an approval for 5 years. Yes, when you go for a renewal, you only get an approval for 5 years. Now, income tax has come and clarified that at any point of time, I noticed that for the last 2 previous years, your trust turnover total income, your trust reported total income without giving effect to section 11 and 12. In simple words, your gross receipts, or what we call as your turnover. Yes, so income tax now comes and says, if I look at your turnover, your gross receipts, and the gross receipts is up to rupees 5 crores for the last 2 years, both included. Then in that case, I will now give you an approval for 10 years. I'll give you an approval for 10 years. Understand, this is only for the renewal part. So if you go for a renewal to assessing to your PCIT and you tell the PCIT that, sir, last 2 years, my total income, if I don't give the deduction, would have been less than or equal to 5 crores, they will give you an exemption registration for 10 years, not for 5 years, 10 years. Keep this in mind that this is only coming for renewal parts, which means if you are already registered and you're asking for renewal, I'll give you 10 years. If you're going for a new renewal, 10 years. If you're getting for your final registration, 10 years. But if you're applying for the very first time, then in that case, it is not going to be 10 years. You will only be given for 5 years, because understand, when you're applying it for the very first time, you have never even been registered earlier. If you have never even been registered earlier, I don't know what your total income would have been if I would have given you exemption. So this is only for people who are already a charitable organization and are requesting a renewal. Expect a tricky question around this. If you get a question in examination which comes and says, I am a charitable organization registering myself for the very first time, no exemption will be granted to you for 10 years, you will only get it for 5 years. After you have been registered at least once and then you ask for renewals, you will get it for 10 years. Keep that in mind. So which means if I'm going from provisional to final also, it is 10 years, because I was already there once. So you have to be registered at least once earlier for you to get an exemption of 10 years. Keep that in mind. A very good question can come around this. Very, very careful. Clear? NPO organization has only that, people. Second exemption which is there is for the denial of exemptions. As you all are aware that when it comes to section 11 and 12, there is a specific section called section 13 which comes and says, if you are going to apply any amount of the trust for the benefit of specified persons, I will not give you the exemption anymore, but rather treat it as a specified violation to be taxed at the rate of 30%. Now, what is specified person has a very small change to be kept in mind. Until last year, they used to come and have different rules, but the rules are now like this. It comes and says, when it comes to your specified persons, in specified persons, if going forward a person contributes more than 1 lakh rupees during this year, or overall till date YTD he has contributed 10 lakh rupees, then in that case that person will be called a specified person. The rules were a little different earlier, people. Last time and all, they only used to talk about YTD concept. Now it is first current year data, then YTD concept, which means current year I have contributed more than 1 lakh, specified person, or current year I have contributed less than 1 lakh, but overall till date my contribution has already crossed 10 lakh rupees. I will be called a specified person. For these parties, please do not apply any money for their benefit unless it is for medical reasons, educational reasons, and it is within fair market value rules. Apart from that, if you use it for any of these specified persons, income tax will treat it as a violation and will tax at the rate of 30%. Clear? Yes. Good. We're already halfway through, people. I think we have been doing an amazing job right now. So let's complete it off very quickly from the next topics. The next one is called as your assessment of business trust. Now, this is not exactly an amendment, but more of a clarification. For those who know, people, when it comes to business trust, there are some rules for you to keep in mind. Let's quickly revise. Business trust rule basically comes and says that when a business trust like REIT or INVIT are going to receive any kind of interest from SPV, any kind of dividends from SPV, any kind of rental income coming from real estates, then those incomes will be passed on through to the shareholders. They will not be taxable in the hands of business trust. It will be passed on through to the shareholders. Any other income that the business trust generates will be taxable in their hands. Problem what happened until last year is when a business trust was getting incomes until last year, we had clarified that 111A was being taxed as per 111A rules. 112 was being taxed as per 112 rules. But the problem was there was nothing called 112A. And therefore, there was this confusion in the market that 112A should probably be taxed at MMR rules. But this was unfair. When two capital gains has been notified, the third one also was required to be notified, and therefore to correct their mistake, income tax has simply come and put a clarification here which comes and clarifies that now if a business trust is generating 112A incomes, then that is also going to be taxable as per 112A rules, which is nothing but 12.5 in excess of 1,25,000. Very simple clarificatory amendment for you, not very critical. If you did not know about this also, in exam when you see 112A, you automatically will move forward to do 12.5 in excess of 1,25,000. So until last year, this was a challenge for you to keep in mind that you had to tax at MMR. Now you don't care. Now you know that 112A is 112A rule. So therefore do it properly. Simple, straightforward. Yeah. Amazing. Let's move on to securitization trust. The securitization trust has a small amendment which comes to TDS rules, people. Now, until last year, the securitization trust had some difficult rules which came and said if the payee is going to be a resident person, then you're going to do 25% for an individual HUF, and then for balance you'll do 30% and all. Now they have standardized this. Your securitization trust and your AIF rules have made the same, which means now both securitization trust and AIF come and say that when AIF or securitization trust has to deduct TDS on a resident party, they will deduct TDS at the rate of 10%. Yes, no change in the non-resident rules, people. The resident rules alone have changed, so you'll now deduct TDS at the rate of 10%. What is securitization trust concept? Securitization trust basically comes and says any income coming from securitization activity will be taxable in the hands of the shareholders. Everything else alone will be taxable in the hands of securitization trust. So whatever money of securitization activity you're passing on to your shareholders, if it is a resident, now you'll deduct 10% of taxation. That is what they've clarified, people. Very simple, straightforward amendments, nothing great about it. Yes. Amazing. Let's go forward. We are at chapter number 32. I've already started my module number 2. Module number 2, very important chapter, people, because this is where you're going to get a lot of questions in the current examinations. You will get it over the next course of 3 attempts, May 26, September 26, Jan 27, chapter on TDS. What does the chapter on TDS basically come and say? That if you're going to deduct TDS, now there is a change in threshold limits. Threshold limits are as follows. When you are under section 193, which was on interest on securities, until last year there was no clear thresholds given. Every individual bonds and securities had their own thresholds. Now they've come and put a standard concept. Standard concept comes and says you will not deduct TDS up to 10,000 rupees of interest for any party. If the party is going to get up to 10,000 rupees as a resident person, don't deduct TDS under 193. Otherwise deduct at the rate of 10%. Rule number 2, which is your section 194A. For those who remember, people, interest on deposits. Until last year, the rules was 40,000 and 50,000 and all. Now the rules have changed significantly. It says if you are going to go for any time deposits with the bank and all, the limit has now jumped to 50,000 rupees for a normal person and 1 lakh rupees for a senior citizen. What is it? 50,000 for a normal person, 1 lakh rupees for a senior citizen. If you are going to go for normal interest from company deposits and all, then the limit has now jumped to 10,000 rupees. Earlier this was 5,000 rupees. Now it has become 10,000 rupees. So what is 194A saying? Going for fixed deposits up to normal person will get 50,000 rupees tak no TDS, 1 lakh rupees for resident persons. Interest coming from company deposits will go for 10,000 rupees of no TDS under 194A. If you're going to cross this limits, go for 10% accordingly. That is what the limits are. Rule number 2, when it comes to 194B and BB, which is your casual incomes, for those who know, people, casual income was liable for TDS at the rate of 30%. Current year transaction comes and clarifies that when you talk about casual incomes, it is no more 10,000 rupees per annum, it is 10,000 rupees per transaction, which means every casual income that you're going to earn, and if the casual income is going to be less than 10,000 rupees, you're not going to be liable for TDS. Yes, this is actually kind of better, people. We always used to think that it is 10,000 per transaction, but it was not. It was unfortunately 10,000 per annum. This probably comes and clarifies that if a person is going to earn incomes from different parties, then in that case, they should not be taxing it accordingly. Yes, so that is what the rule is. Any doubts on this rule? Clear? Good. Next one is your 194D, which is your commission. I think a standard change, if you can understand like this, people, is the following: that when it comes to commission for the current year, the commission is as follows. Every TDS is going to be at the rate of 2% and every threshold is going to be at the rate of 20,000 rupees. Full stop, straightforward. So if it's going to be commission for insurance, commission for lottery, normal commission, whatever it is, go for 20,000 rupees ka threshold limit, 2% ka tax TDS rate. Yes, that is what the rules are. Very simple, straightforward. Next, it comes to 194I, which comes to rent. People, here is where a significant changes come, and I do expect this to be the most important question from your examination perspective. Your examination question will be triggering around 194I, at least in one of the attempts. The question is now this. Earlier, until last year, when it was 194I, you had a threshold limit of 2,40,000 rupees per annum. For the full year, it was 2,40,000 rupees. And then there was a section called 194IB. 194IB used to come and say that if you're an individual who is having immobile property rentals, then in that case, it was 50,000 per month. Income tax is now decided. Let's standardize both together, which means now 194I also talks the same language as what 194IB says. 194I comes and says will now not be liable for TDS if the monthly TDS is less than 50,000 rupees, which means now it does not matter even if you have 60,000 rupees for a full year rental. If the month rental has gone more than 50,000 rupees, TDS is applicable. Now you can get some very beautiful questions in examination. Imagine if I give you a question in examination, the question comes and says, I have taken a property on rent in the month of February. In the month of February, I took a rental property where the rent amount is 60,000. Yes, which means for 2 months, I would have only paid 1,20,000 rupees. Now, for that 1,20,000 rupees, should I deduct TDS? Answer is yes. Now, I don't care what happens on a per annum basis. I only am bothered on what happens on a per month basis, which means for the month of Feb, it was 60,000 rupees. TDS is applicable. For the month of March, also it was 60,000 rupees. TDS is applicable. Yes, that's the amendment which has come in, people. So be very, very careful on this amendment. It's no more 2,40,000 rupees per annum. It is 50,000 rupees per month. Yes. Good. Next comes your 194J, one of the favorite sections for you and me as a qualified chartered accountant. Until last year, the limits were 30,000 rupees. Now the limits are 50,000 rupees. So now you will not be liable for TDS up to 50,000 rupees worth of payment under 194J. Under 194J, that's the simple straightforward limit. Next comes your 194LA. For those who remember, people, 194LA was all about your compulsory acquisition. Until last year, the compulsory acquisition was 2,50,000 rupees. Now the compulsory acquisition is 5 lakh rupees. So 5 lakh rupees is now the threshold limit for your compulsory acquisition. Up to 5 lakh rupees, they will not deduct TDS. After 5 lakh rupees, they will deduct TDS at the rate of 10%. Who will deduct? Government will deduct. Government will deduct 10% TDS if the threshold limit has crossed of 5 lakh rupees. That gives me the last section, people, the completely amended section. While this was introduced last year itself, but it was never notified last year, it was only applicable from 1st April of your attempt, and therefore this is an amendment of the current year. The point which comes and says, going forward, if any partnership firm gives any kind of remuneration to a partner which is taxable, what are the taxable ones? Interest and remuneration, salaries and all those things. Share of profit is not covered here. So any kind of salaries and remuneration given to partners will now be liable for TDS at the rate of 10% for a threshold limit of 20,000 rupees. Yes, so that is what the amendment has come in. So be very careful on this amendment. You will get a question on this in examinations, in one of the examinations. 194T, making payments to partners from a partnership firm, will be liable for 10% TDS with a threshold limit of 20,000 rupees. Clear? Good to go? Perfect. That moves with the TCS people. Now TCS has some really critical amendments, so please be mindful of TCS amendments. TCS amendments are as follows. First things, they have come and clarified that there was something called as forest produce. There was something called as forest produce. Now they have come and clarified that when it comes to forest produce, I will only be liable for TCS on forest produce if it is obtained under a forest lease. Which means if you say forest produce without a forest lease, no TCS on that. Only forest produce with the forest lease will be liable for 2% TCS, except for tendu leaves. Tendu leaves are basically those things which you use for cigarettes. Cigarettes pay whatever tendu leaves you're going to buy will be liable for TCS for sure. But if you're going to have a forest produce, it is only going to be there if it is obtained under a forest lease, point number 1. However, when it comes to timber, the amendment comes and clarifies, in a timber, whether it is on account of forest lease or without a forest lease, it does not matter. It does not matter. Any timber which you are going to buy will be liable for a TCS at the rate of 2%. At the rate of 2%. Until last year, the rates were 2.5% people. Now the rate has been changed to 2%. Yes. So timber, whether forest lease or not, is 2%. Other forest produce only when it is under forest lease will be taken for 2%. That is what the conditions are. Next, something which was already introduced last year, but for some reason ICI study material only introduced it for this attempt, that if you are going to buy any kind of luxurious products, for those who remember people, until last year we had a concept called as motor vehicles. So if you bought a motor vehicle exceeding 10 lakh rupees and you were liable for 1% TCS. Later on, the amendments came in, they came and clarified, we are now going to not call it motor vehicles alone, we are now going to call it luxurious products. So luxurious products are now going to be liable for a TCS at the rate of 1%. What are the luxurious products? Any kind of wristwatch which you buy for more than 10 lakhs. Any kind of art pieces that you buy for more than 10 lakhs, any kind of collectibles like coins and stamps that you're buying for more than 10 lakhs, any kind of yacht, rowing boat, canoe, helicopters, any kind of vehicles that you're buying for more than 10 lakhs, any kind of pair of sunglasses that you're going to buy for more than 10 lakhs, any handbags and purses, any pair of shoes, any sportswear equipments, golf kit and ski wears, any kind of home theater system, and horses that you're going to buy for race club and polos are all now going to be liable for a TCS at the rate of 1% if individual asset is going to be more than 10 lakh rupees. Understand very carefully, this is not for the full year, it is for each asset, which means I should buy one wristwatch for more than 10 lakh rupees in order to be liable for TCS. That is what the conversation is. One wristwatch for 10 lakh rupees, one wristwatch for one art piece for 10 lakh rupees, and so on and so forth. These items, if you buy for more than 10 lakh rupees, you're getting TCS at the rate of 1%. Clear? Yes, good. Next is your overseas transaction, people. Now, overseas transaction has two very critical amendments that you have to keep in mind. Until last year, overseas transaction, you should come and say that if you're going for any kind of other than overseas travel package, if you're going for anything other than overseas travel package, TCS was only liable up to 7 lakh rupees. Here, the limit has now increased and the limit has now become 10 lakh rupees, which means up to 10 lakh rupees, you will not be liable for TCS in an other than overseas travel package. If you are going to go up to 10 lakh rupees of foreign payments, no liability for TCS. Above 10 lakh rupees, liability for TCS has arisen upon. Now, the amendment in the current year is very, very critical for you to keep in mind. The amendment in the current year is for educational purposes. For those who know people, until last year, the rule was that if you are going to make a payment outside India for educational reasons, then I had asked you to split into two reasons. Reason number one is that have you paid this money out of an educational loan that you took from financial institution, section 80E conditions. If you had taken an educational loan for the purpose of transferring money outside India, last year used to come and say 0.5% TCS will apply on that. If it is other than educational loan, then it was 5%. After a lot of representations, Nirmala ma'am has made it clear that boss, when you're already taking a loan from a bank to pay money outside India, paying an additional TCS on that is just going to add burden to you. So the current year amendment comes and clarifies that if you're going to take a loan for the purpose of paying money outside India, then in that case, TCS on that will be 0. TCS on that will be 0. I will not be making you liable for TCS on an educational loan. If you are going to make payment from your own pocket, from your own personal sources, then it is going to be liable for 5%, same as last year. But if you're going to have any educational loan, then in that case, no TCS will apply on you. You can make the payment freely without any TCS. That is what the conditions are. So what does LRS come and say, people? LRS comes and says up to 10 lakh rupees, no TCS. After 10 lakh rupees, if you're going to make the payment for educational loan purposes, no TCS. If you're going to make payment of education from your own sources, 5%, medical reason 5%, any other reason 20%. If you're going to go for overseas travel package, then in overseas travel package, what will you do? For the first 10 lakhs also, you're liable for 5%. After 10 lakhs, you'll be liable for 20%, and that is what the conditions are. Yes, simple, straightforward, people. That is what the conditions are. I hope this makes sense to all of you. Clear? Good to go? Perfect. This is what your TCS rules are. I think if you've done the TCS rules properly, people, you will able to get easily about 4 to 6 marks in your examination. So be very, very careful on this. Quick summary on what we have discussed. If you go to 193 interest on securities, limit has become 10,000 rupees. If you go to 194A interest on deposits, then it is basically 50,000 rupees for normal citizen, 1 lakh rupees for senior citizen, 10,000 rupees for company deposit. If you're going for casual income, people, casual income says 10,000 rupees per transaction. Any kind of commission, limit is 2%, threshold is 20,000 rupees. If you're going for 194J payments, which is your professional payments, then it is 50,000 rupees each transaction. If you're going for 194LA, which is your compulsory acquisition, number is 5 lakh rupees right now. Amendment of current year is 194T. Any payment made by a partnership firm to its partner which is taxable in the hands of partner will be liable for a TDS at the rate of 10% on a threshold limit of 20,000 rupees. TCS scheme comes and says that if you're going for timber is 2%. Any forest produce only under forest lease will be 2%. Notified goods have been given to you. Luxurious products with a payment more than 10 lakh rupees will be 1%. Overseas transaction comes and says that if you're going to make payment up to 10 lakh rupees, no TCS. After 10 lakh rupees, educational loan is no TCS. non-educational loan is 5%, medical treatment is 5%, other payments are 20%, overseas travel package up to 20, overseas travel package up to 10 lakh rupees will be 5%, after 10 lakhs will be 20%. Yeah, amazing. People, if you're able to revise it along with me like this, then you are already through with examinations. Keep up the pace. You're doing an amazing job. Yes, good. Let's proceed forward to the smaller chapters. The smaller chapters is section number 34 right now. Chapter number 34 talks about return filing. Only one amendment in return filing, basically on your updated return. For those who remember, people, we had an updated return concept. What was the updated return concept? If your assessment year is, let's say, 26-27, then assessment year 26-27, you will be filing your income tax returns by, let's say, 31st July or 31st October or 30th November. Yes, if you are not able to file your returns by that time, you were now eligible to file something called as revised return by 31st December. So you had revised returns here, you had original returns here, and that's how the conditions were. However, if you were unable to file anything before by revised return due dates also, and you later on wanted to avoid any kind of interest and penalty, we had a concept what we used to call as updated return. Updated return used to come and say that you can file updated return for another 2 years from the end of the assessment year, which means from 31st December go for another assessment year end, which is 31st March. After 31st March, you could have filed your return like this. So for assessment year 26-27, you could have filed your return up to 31st March 2029. Yes or no? Yes. So this would have been 31st December 26. This would have been 31st July, 31st October, 30th November 26. And then what you will do, you could go for an updated return filing up to 31st March 2029 with the condition that if you are going to file something by 31st March 28, which means within 1 year from the end of the assessment year, then you would have to pay an additional tax of rupees 25%. Whatever additional interest and tax you had to pay 25% on this. If you are going after 1 year, then it was 50%. Then it was 50%. I hope you remember this provision, people. Yes. So updated return says from your end of the assessment year for the next 2 years, you can still file an updated return paying additional taxes to income tax department by paying additional 25% within 1 year and additional 50% within the second year. Now, Nirmala ma'am apparently came and tell on the budget speech that apparently people have been using updated return to the best extent possible, and everyone has become cleaner and they are now reporting more incomes to income tax department. So they think this scheme has become a major success. Because the scheme has now become a major success, Nirmala ma'am proposed that we will now extend the timeline so that we will give you additional opportunities. The additional opportunities now come and say that you can now file an updated return for an additional 2 more years, which means now you will get time limit up to 31st March 2031. 2031. In simple words, Nirmala ma'am says you can now file an updated return for 4 years from the end of the assessment year. Rahul, now for 2 years itself you said 25 and 50%. What will happen for 4 years? Third year income tax says that if you are going to file anything within the third year, you will now have to pay an additional 60%, and if you're paying anything until the fourth year, you have to pay an additional 70%. That is what the conditions are now. Yes. So what are the rules right now, people? Within 1 year, you have to pay 25%. Within 2 years, you have to pay 50%. Within the third year, you have to pay 60%. And within the fourth year, you have to pay 70%. Pathetic numbers. Pathetic numbers. Honestly, pay penalty and go, better than paying this. Yes. But nevertheless, that is what the amendments are. So the amendments come and clarify. If you are having a due date return which has been lapsed, then you can file an updated return up to 48 months, which is nothing but 4 years now. If you're going to file an updated return, the payments are for the third year it is 60% and for the fourth year it is 70%. That is what they have come and clarified to you. They have put in an additional condition, people, that because we discussed about it in classes also, when it comes to updated return, you can only file it when you're cleaner, which means at any point of time, if department has launched a proceedings on you, any prosecution, penalty, normal assessment proceedings also, updated return was violated. Now, because I'm giving you time limit up to 48 months, your time limit of reassessment also comes into picture, and therefore income tax has now come and clarified. If any notice has been issued to you under section 148A, which is your reassessment notice, then in that case also you cannot file an updated return. However, later on, if I find out that after issuing the notice, I never even wanted to proceed on reassessment, I issued 148A, I asked you some queries, and in the queries I found out that it is not a fit case to reopen for assessment, and I dropped the proceedings. After that, now you have time. proceed for updated return, which means if the proceedings are ongoing, you will not be eligible for updated return. If the proceedings has been dropped, you can proceed on doing updated return. That is what the conditions have been clarified to you, which means updated return can only be proceeded on when you are the one voluntarily disclosing something. Department should have not launched any proceedings on you. With no proceedings in your hand, if you go for updated return, that is permitted. Any proceedings started on you, until the proceedings are going on, do not file an updated return. Clear? Yes. Perfect. That is what the amendment says. The next amendment is a very small amendment, people, not relevant at CA final level. The amendment basically comes and clarifies that if you have to update your PAN and Aadhaar together, if you have to link your PAN and Aadhaar together, the updated time limits, which keep changing every single year, has now been changed to 30th September 2025. So up to 30th September 2025, you can keep linking your PAN with Aadhaar. If you have not linked it before that 30th September, then in that, if you have not linked it after 30th September, I will start invoking issues like you will not be given refunds, you will not be given interest on the refunds, TDS will happen at the higher rate of 20%, TCS will happen at the higher rate of 2x or 5%, whichever is higher. That is the rules which are coming in. The amendment other than that comes and clarifies that you will not be liable for these kind of liabilities if the TDS has to be deducted at higher rates, provided the PAN is made operative within 2 months from the end of the month in which the amount is paid. Which means I will now have an additional time limit of 2 months from the end of the month. 2 months from the end of the month, if the assessee can come and clarify to me that, sir, I have completed my linking of PAN with Aadhaar, then the higher rate of TDS will not apply to you. Now, practically, this is not implementable because the moment the PAN is showing invalid, the moment you file a TDS return, demand will throw to you. Yes, if later on also he goes and links his PAN with Aadhaar, I don't think the updated return is going to modify itself. So yes, practically this is causing problems, but theoretical perspective, they have come and clarified for the next 2 months, you still have a liberty, you have a cushion zone, which means if I'm going to make the payment to you right now and I inform to you that I'm going to deduct higher rates, within the next 2 months, if you can clarify your mistake and you can get your PAN and Aadhaar linked off, we will not deduct at a higher rate. That is what the conditions are. Any doubts on the conditions to me? Clear enough to go? Perfect. Let's move on forward to the smaller things, people. Very small things which are pending for you right now. One is chapter number 35, which talks about your assessment proceedings. For those who know, people, in assessment proceedings, we have a section called as section 143.1. Section 143.1 is basically an intimation section that if you file a return, the department CPC, Centralized Processing Center or Centralized Processing Cell, has an obligation that they have to issue an intimation to you. In this intimation, their job is very simple. They will go and make some minute arithmetical changes. Arithmetical changes like they found out something in the tax audit report which is not reported here. There are some plus or minus errors and all that stuff. Those are things which is called as 143.1. Amendment in the current year now comes and clarifies department has been given higher powers right now to not just check on the current year information. They can also start matching things with the past year data. Which means now they come and say a return can be made with the following adjustments of inconsistency in the return with respect to information in the return of any preceding previous years. So in the past years, if you had any errors and that error is noticed by CPC, they can make that changes in the current year as well. What kind of changes are you talking about? Imagine last year's return I filed and I reported a loss of 3 crore rupees. But current year when I'm filing my return, I am going and reporting a loss of 4 crore rupees. Not fair. Income tax department now has the power. The department can say, last year when you filed the return, you only showed 3 crore rupees. How did the number become 4 crores? I will only give you 3 crores. Point number 1. Or probability number 2. It may be a scenario that last year you have claimed a depreciation and after depreciation your closing WDV showing 5 crores. But current year suddenly when I opened the return says opening WDV 7 crores. How will it become 7 crores? Not possible. Income tax department says in that case now I have the powers under 143.1 itself when I can verify last year's return and current year's return, and if there is mismatch I can make adjustment accordingly. Perfectly permitted. Perfectly permitted. That is what the 143.1 adjustment comes and says. Any doubts on this part? Clear? Yes? Good. Next comes your search and seizure. Now, search and seizure has a very small amendment, people, but yet a very critical amendment which you have to keep in mind. For those who remember, people who have learned search and seizure last year, the last year was the amendment year with the block concept. The block concept used to come and tell one thing. As an assessee, your requirement was very simple. When a notice is issued to you under search and seizure and they ask you to file a return, you were obligated to file a return in a weird fashion. The weird fashion return was that you have to also disclose whatever incomes you already reported. Incomes which you already reported in your returns, incomes which you already reported in your assessment. Take all that return incomes and then they asked you to also report your undisclosed income. Which means in one return itself, I will give you 2 numbers. One will be what is the actual incomes and one is what is the undisclosed incomes. And then income tax department used to come and say, actual incomes pay you have already paid tax. So let it go. Undisclosed income pay, they were asking you to pay the tax at 78%. Now, Later on, department realized then when in this return, I'm anyway going to ignore the original income and I'm anyway going to tax the undisclosed income at a flat rate. I don't see the reason why you have to report both the incomes together. This is just an unnecessary waste of time for both of the parties. Both of the parties are unnecessarily getting confused on things which is not even required. With that understanding came in the amendment of current year. The critical amendment of current year very simply comes and says that from the current year, any person who's being caught in a raid, any person caught in search and seizure, when he is asked to file when he is asked to file a return of income, in this return of income, he will only file one information, the information on his undisclosed income. I do not want to know what happened in your earlier information. I do not want to know what incomes you have already reported. I do not want to know what taxes you have already paid. I do not want to know what assessment happened. My logic is very simple. When I give you the return, I am giving you an opportunity that you can voluntarily disclose your undisclosed income. So the only thing you're going to report right now is your undisclosed income. Only thing department will do is add his undisclosed income. The only two things which will be available in the search and seizure report will be the undisclosed income on which you're going to tax 78%. Makes life easier, makes things safer, and that is what the amendment is. Amendment comes and clarifies the person shall set forth in his return of income only those of his undisclosed income of his block period, which means now you are not going to report your total income, you are going to report only your undisclosed income. That is all that they ask for you. Yes. So the only information you have to report is your undisclosed income. I'll show it to you also, people. It says when it comes to your undisclosed income, the issue is like this. Any kind of incomes when you're going to disclose, undisclosed income is the only thing which is going to be determined by the assessing officer, and this income is going to be taxable at the rate of 78%. While determining undisclosed income, you need to ignore the following information. See, they said ignore these following information. What are you going to ignore? You're going to ignore any income which is declared in the return of income which you originally filed. Any additional income which has been coming to assessment pass after assessment procedure, whatever income has been reported of. Any kind of current year and previous year income for which the due date of return filing has not expired, which means you are able to file the return on your own. These are all legally reported incomes. You would have anyway reported it from your side, and therefore don't disclose this as undisclosed income. Otherwise, it will be taxable at 78%. However, if the assessing officer is of the opinion that any part of this income is undisclosed, then he may add it to his statement, which means assessing officer can tell you whether this is disclosed or undisclosed. If he thinks this was an undisclosed information, if you would have not disclosed it, then he will ask you to report it. Otherwise, if you itself in your books of accounts have properly maintained these entries, then you can come and say, sir, this was disclosed income. I am anyway going to file this in my normal return of income, not going to report it in search and seizure reports. Next, any kind of previous year income which relates to any international transactions or STT, because these transactions are now going to be liable for transfer pricing rules. Let's go and disclose it under transfer pricing rules or Black Money Act. It has nothing to do with search and seizure report. So they've now come and clarified that any international transactions which are undisclosed is anyway part of Black Money Act and should not be reported in this transaction. Next, any kind of interest, dividends, royalty, FTS which are taxable as per 115A, because anyway it does not matter. These incomes are anyway going to be taxable at the flat rate of 20%, 5% and so on and so forth, and therefore I don't need to worry about these kind of incomes. These cannot be undisclosed whatsoever because it is anyway government approved. Next, any kind of investment income, LTCG income for non-residents under Chapter 12A. Chapter 12A is basically your NRI taxation. Yes, your non-resident Indian taxation, because again the same things, these incomes are going to be taxable at the rate of 20% of interest, and your capital gains rules of 12.5% will apply. So that is why they said don't report these incomes of. Next, pension and interest income which is deductible under 194P, because anyway bank would have taken responsibility on this. There is nothing undisclosed about it. In simple words, income tax says my income tax return ITRB which you are going to file for your search and seizure report should only have your undisclosed income, nothing else. Don't report anything other than the undisclosed income. That is what the amendment is. Clear on the amendment? Yes. Next things, people. Other smaller amendments which has come in the current year, once come and clarify that if at all you have to furnish a return, I can give you time to furnish the return for an additional period of 30 days. Normally, department will allow a time limit. That time limit cannot exceed 60 days. Now, department says you can now extend it for another period of 30 days for the following condition alone. Read the following condition. It says where the due date for furnishing return for the PY immediately preceding the PY in which the search was initiated has not expired, which means imagine if I do the search and seizure in the month of July. When I'm doing it in the month of July, people, has the person already filed his return? No. If I'm doing search and seizure in the month of July of current year, for last assessment year, he would have not filed his return even now because the due date is 31st October. So you need to wait. In that case, they say the assessee can request in writing for extension of the time limit to get his accounts audited for the previous year. To get his accounts audited for the previous year. So if he comes and clarifies that, sir, I have been caught for raid is going on. I have unfortunately for assessment year 25-26 still not filed my return because I'm yet to get my audit done. In that case, income tax department will come and give you an additional time of 30 days for you to complete your audit and then file your returns. So that I can be sure that these incomes are already going to be reported by you. Those are no more undisclosed incomes. The balance income is what you report in ITRB. So they are now giving you an additional period of 30 days for you to file your original return of your last year plus your ITRB of current year. Are we making sense on this? That is what they have come and clarified to you. Yes, so this is a time limit amendment, people. Not important. Next, the last thing comes and says, this year comes and clarifies that when it comes to undisclosed income, they have now come and clarified that undisclosed income now also includes virtual digital asset, basically your cryptocurrency. So now come and clarify that if a person is having cryptos in his hand and cryptos are being kept as undisclosed income, then in that case, cryptos can also be caught for the purpose of search and seizure, and now they can take it over and tax at the rate of 78%. Clear? Yes. Next amendment comes and clarifies that when it comes to search and seizure, people, one thing you would have been aware that when it comes to search and seizure, if there is any old assessments going on, any assessments which are pending of the past years, they will all stand abated. They have now come and clarified that any notice issued for the earlier years falling within the block between the period the search of requisition was initiated and up to the date on which the block assessment order was passed will also stand abated. The issue which came up is that assessment is not yet started. We've just given the first notice, 143.2 alone has been given or 148A alone has been given. Can we continue with our proceedings? Answer is no. The clarification now comes and says that just because an assessment is started does not mean you can continue with it. Even if assessment has not started but a notice has been initiated, that also will be abated. Now everything is going under search and seizure. Don't wait for anything. The moment search and seizure starts, that's the only thing which can be done. Nothing else can be taken up. That is what they've come and clarified. Next things they've come and clarified that when you start assessment, like I told you people, now assessing officer is only going to determine your undisclosed income. Assessing officer is no more going to determine your total income. He's only going to determine your undisclosed income. After he determines your undisclosed income, he will now pass an assessment order within 12 months from the end of the quarter in which the last of the authorizations took place. Until last year, this was 12 months from the end of the month. Now it has been made from the end of the quarter, which means if your last of authorization, your Wakalatnama, what we call is the Wakalatnama, has received on, let's say, July. In that case, what we'll do is we will go to the end of the quarter, April, May, June. You have done. July is when you got the authorization. So July, August, September. From September, another 12 months will be given to you. From September another 12 months will be given to you, and therefore in classes also I told you people the time limits are very simple. Your time limits are going to be somewhere around 31st March, 30th June, 30th September or 31st December. One of these time limits is what will be notified to you. One of these, because obviously 12 months from the end of the quarter means this quarter ka next year. Therefore this is how the years are going to be, which means one of these 4 dates is going to be your assessment closure. However, if you remember people, we just discussed about this, that I came and told you that if your audit is not done for the last year, you may ask for an extended 30 days from the assessing officer. Income tax then came and clarified that if you are going to request another 30 days from the assessing officer, even the assessing officer should get an additional 1 month. And therefore they came and clarified that if a person is going to request for that additional 30 days to get his books of accounts audited, then this will not be 12 months, this will now become 13 months, which means it will become 31st March plus 1 month, it will become 30th June plus 1 month, it will become 30th September plus 1 month, and it will become 31st December plus 1 month. This is what the amendments will be. This is what they've come and clarified, people. A little difficult for you to keep an examination mind. Let's hope it does not come for examinations. If it comes for examinations, you can expect this in question number 5. If it comes in question number 5, bonus, you're anyway not going to attend it. If it comes in MCQs, be very careful. Yes. So what is amendment, people? Quickly for me. The amendment comes and clarifies that when the Wakalatnama gets over, the last date of authorization is made. From that date, you will go end of the quarter. From that end of the quarter, you'll go an additional 12 months in order to complete your assessment of. But if at any point of time you've requested for an additional 30 days to get your audit done, in that case, you can ask for an additional 1 month to complete assessment, which means it will become 31st March plus 1 month, which is 30th April, 30th June plus 1 month, which is 31st July, 30th September plus 1 month, which is 31st October, and 31st December plus 1 month, which is 31st March. Clear? Yes, that is what they've come and clarified, people. The last thing which they've come and clarified is when it comes to books of accounts, any books of accounts and all which is seized under search and seizure has to be returned within 1 month from the end of the quarter in which the assessment order is passed. So after you complete the assessment order, again they'll take another end of the quarter, and from the end of the quarter they'll give you 1 more month, which means from 31st March they'll go 30th April. 30th June. From 31st March they'll go 30th June. So which means they'll go 30th June and then they take an additional 1 month. If you're going from 30th June, they'll go 30th June to 30th September, then take an additional 1 month. If you're going from 30th September to 31st December plus an additional 1 month, that is what they will be filing off. Again, you can't remember those kind of things, too complicated. So let's let it go. Yes, let's let it go. I know as a faculty, I'm not supposed to tell you these things, but okay, people, some things which you can understand, some things which you can't understand. Let's not take too seriousness about it. Yes, we are almost at the end of this. Let's finish it off. Let's be with me, people. We are at 1 hour, so amazing job. Let's finish it off the balance. And we are into transfer pricing provisions. No significant amendment to transfer pricing provisions. All important things like safe harbor rules and all got notified last year. The amendment of the current year is basically as follows. Income tax has now come and clarified that, my dear child, imagine if you are being picked up for TP assessment, and in the TP assessment there has been an adjustment which has been made. For example, I have come and clarified that my TP adjustment was, let's say, 5 crore rupees. Yes, my TP adjustment has been determined as 5 crore rupees, and for some reason the assessee feels yes, 5 crore rupees is valid, but I don't want this 5 crore rupees to change next year. Unnecessary. Next year the officer again comes back and comes and says we will relaunch it, let's do 7 crores. Next year again he comes and says we relaunch it and do 10 crores. No. In order to ensure certainty, there has been a proposal which has been made. The proposal which has been made is that if for one assessment year the assessing officer, the TPO has passed an ALP adjustment and you are comfortable with that adjustment, you can file an application with the TPO and come and tell the TPO that, sir, whatever ALP you have determined for this, I would like it to continue for the next 2 years as well. I would like to continue it for the next 2 years as well, which means whatever ALP adjustment has happened right now, the same ALP adjustment will be carried forward for the next 2 years, and you will get a certainty on those. You will get a certainty of those. That is what the amendment says. Let's read, and if you understand, let's take it forward. It says, when it comes to TPO reference, people, after reference has been made to TPO, a TPO will call upon data and will ask for an ALP adjustment where the assessee exercises an option in such form, manner and within prescribed period. The TPO shall, within 1 month from the end of the month in which the option is exercised, declare that the ALP determined shall be valid to similar transactions for the following 2 previous years. Which means for 1 year, if I have determined ALP, assessing officer will take the same ALP for the next 2 years after I make an application to him. In such a case, no reference will be made by the assessing officer to the TPO for the following 2 years. For the next 2 years, assessing officer will say, let's not discuss. Let's not discuss. It does not matter. Let the assessing officer handle it. Let the assessing officer handle it. The AO shall instead recompute the income for such basis the determined ALP for the assessment years. And that is what the clarification is. So they have come and clarified that if an assessing officer, if the TPO has approved an ALP or TPO has made an adjustment under ALP, then you can exercise an option, and if you exercise the option, the assessing officer will not even refer the next 2 years for cases of ALP. He will come and say, I will itself pass the adjustment. However, notice this option to replicate is not applicable if the case is picked up for search proceedings, which means if you have gone for raid, then in that case, I'm sorry, this is not applicable. Every year has to be assessed individually. And that is what TP adjustment is. Not a very significant amendment, people, but still good enough to go. Shall we proceed forward? Great. That moves me to the 41 chapter, people, which is your non-resident taxation. Non-resident taxation chapter has an amendment same as last year. Last year we had an amendment on cruise ships. This year we have an amendment on technological facilities. Income tax has now come and said that now if any person outside India is going to help a party in India to set up an electronic manufacturing facility or connected facility for manufacturing or producing electronic goods or articles in India, which means a person outside India is going to provide me such services which is going to help me set up an electronic manufacturing facility in India, then that non-resident, whatever payment I make to that party can now be taxable at a presumptive rate of 25%. Which means if I come and say that I am a person who's sitting outside India and is helping Apple set up a manufacturing facility in India, and Apple is going to pay me 10 crore rupees for it, income tax will say take the 10 crores, 25% of that is your PGBP income right now. So 2.5 crores will be my PGBP income, and on that PGBP income, I can pay my tax accordingly. Yes. So what is the rule right now? The rule says if I'm going to provide any electronic facility, whatever money I get, 25% of that alone will be allowed as PGBP income, and on that PGBP income, I can pay my taxes. Notice very carefully, 25% is not the tax rate. 25% is the PGBP income on which you will calculate tax rate. I hope you know presumptive rules, people. 7.5 for cruise ship, 5% for aircraft, 10% for turnkey project, 10% for your supply of prospecting mineral oils, 20% is for cruise ships, 25% is for your providing electronic facility, and this electronic facility is your PGBP income. Notice carefully, it says it is your presumptive income. So this is going to be your presumptive income on which you will pay tax. Now my gut feeling, while I'm not really clear about it, my gut feeling is this is an amendment which has been brought in specifically for Apple. For those who know, people, Apple has come with a system that Apple is now planning to shift its base from China to India. So for those kind of opportunities, and to give them an opportunity to come and travel to India, is this opportunity given to them. Yes. So non-resident who's going to provide services for technology setup of electronic facility in India can be given a presumptive taxation at the rate of 25%. He can offer for this 25% and will not be taxable for any other income. So whatever amount is going to receive, on that amount 25% will be liable as presumptive income, and that is what is going to be taxed off. Yes. Now notice carefully, people, when it comes to presumptive, one thing is very clear, because you've already offered presumptive income 25%, you can't claim any expenses. Yes. So they've clarified that even for 44 BBD, you can't claim any expenses. That will also be taxable at the rate of 25% presumptive income rules. No allowance of any deduction, no allowance of any expenses, no set off of any losses. Take the 25 as it is. Clear? Yes, good. The last small amendments, people, very small amendments. One is your section 115AD. Now this is not an amendment, this is more of a clarificatory thing. Unfortunately, what happened, and this is what we discussed in last batch also, that the problem what happened is when it came to 115AD, wherein the whole income tax in every single place where we had come and told capital gains is going to be transited from 12.5 from 10% to 12.5%, 115AD was missed off. Under section 115AD, last year, unfortunately, Nirmala ma'am forgot to make a change in the Finance Act. Although the commentary came and said that they have made the change, but the Finance Act did not make the change, and unfortunately, that was a open area. ICA played with it very beautifully, and in both September and Jan 26 examinations, there were some beautiful questions coming around this. This year, Nirmala ma'am has clarified it. Nirmala ma'am realized her mistake, and Nirmala ma'am has clarified it was my mistake. Capital gains, traditionally, every chapter has changed to 12.5%. So here also it has to change to 12.5%, and therefore section 115AD now comes and clarifies that any kind of capital gains will be liable for 12.5%. Yes. Most of the amendments in the current year are more like correcting past errors, people. So technically, even if you don't know the amendment, it still does not matter, because you're just trying to do the same thing. You know traditionally that LTCG everywhere has become 12.5. So even if you don't know this as an amendment, the moment you see LTCG, the first thing which will strike your mind is LTCG is 12.5. That is what you're going to do. So there is nothing really to be worried about in this amendment list, people. Yes. Major amendments, if you notice, was TDS only. Apart from that, most of the amendments are not so great as well. Yes, your reorganization of for the remaining period of 8 years and all those things are probably critical. Other than that, most of the amendments are clarificatory. Yes. Next amendment is on your penalty. Penalty time limits have changed, people. When it comes to penalty, they have come and clarified that for imposing penalty under section 275, the penalty will now be 6 months from the end of the quarter in all the scenarios. Yes, earlier the penalties was a little different. Now it is clarified as 6 months from the end of the quarter. So wherever you have to pass a penalty order will be 6 months from the end of the quarter. 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 Everywhere it is 6 months from the end of the quarter. Yes, that is what the amendments are, people. Any doubts on the amendments? Clear. Last two amendments and we're done. See, whole CA final amendments done in 1.5 hours. That is all the amendments are. Nothing critical about it, but still important for you to keep in mind. Amendment is next chapter number 42, which is your reporting financial transactions. For those who know, people, until last year we had a transaction only of SFT. SFT was the only amendment that we had until last year. SFT was the only provision that we had until last year. This year, we have now started additional obligation. A section has been introduced called section 285BB, where now income tax requires that a reporting entity, a person who's trading in cryptos, now have to keep a track and inform about every single person who's trading cryptos along with him. Now, this has not been explicitly notified. It's a section which has been introduced. The rules around this are yet to be notified, so it will not be relevant for May 26 examinations. Maybe the rules of it will come for September 26 and Jan 27, but for May 26, there is no critical rules notified here. Read for me, you'll understand it. You're not going to you're not going to read it from exam perspective, people, because there is nothing to read in this. Yes, the rules come and say a reporting entity as prescribed shall furnish information relating to crypto assets in a statement for such period and such manner for IT authorities within the time limits as may be specified. Nothing has been notified, which means the person who's helping you trade in cryptos now have to keep a track of things. When no statement has been furnished by the reporting entity within the specified time limit, the IT authority can issue a notice requiring him to furnish it within 30 days. If you are not doing it yourself, IT authority will ask you to do it. Where the IT authority considers a statement to be found defective, he can intimate the same and ask for an opportunity to rectify it within 30 days. If the defect is not rectified by the reporting entity, it will be deemed that the inaccurate information was furnished with the statement. If the reporting entity identifies any inaccuracy, he can respond within 10 days to the same. That is what they have clarified. Notice, nothing has been notified. No person, no time limits, no forms, nothing have been notified. So for May 26, not critical, completely not critical. But yes, if you're asking me from a practical perspective, let me clarify this to you. From a practical perspective, now they're coming and clarify that if you're going to be a person who's going to help someone in crypto trading, you are a reporting entity and you will now have to start reporting transactions on behalf of other persons. Given to you as a clarification for you to keep in mind. Yes. Good. That brings me to the last one, people. Now, this is not an amendment, but more of a removal. For those who know, people, until last year, you would have learned there is something called equalization levy, something which was there as per part of Finance Act 2016. First, we had equalization levy 1.0, then we had 2.0. 2.0 got removed last year itself, and then last year we have, 2.0 got removed last year. This year, income tax is proposed. We are going to remove 1.0 as well. Yes. Now, why is this critical? Why am I showing it to you, people? Because ICL loves to test you questions on this. What is the equalization levy is what I'm going to take 2 minutes. I'm going to explain to you. Until last year, the rule was very simple, that if you are a person who's going to make a payment for online advertisement or for digital space to a non-resident not having a P in India, you are supposed to do an equalization levy. The equalization levy was about 6% for a payment exceeding 1 lakh rupee. Yes, so what is the rule, people? If I'm going to make any online advertisement or digital spaces, then in that case, equalization levy was applicable to you if the other party did not have a P in India. Now, the challenge was that if you don't do these kind of payments with the equalization levy, then PGBP chapter requested a 100% disallowance. Now, if you notice, equalization levy has been deleted off. If equalization levy has been deleted off, do I have to do that anymore? No. If I don't have to do that anymore, will I have to disallow something under PGBP chapter? No. And that is what the amendment is. The amendment is for you to keep in mind that if a person is now not required to deduct equalization levy, you can't force him to do that. And if you're not going to force him to do that, then there is no disallowance to be made under PGBP. So if you get a beautiful question in examination, the question says online advertisement services which is paid to a non-resident without deducting tax. Simple, straightforward, tell them ignore. Tell them ignore to come and say that online advertisement spaces for a person who does not have a P in India was earlier liable for equalization levy, but now that equalization levy is not applicable, there is no reason for you to deduct either TDS or equalization levy, and therefore the payment is allowed as an expense, need not be disallowed. That is why this amendment is given to you, people, so that in case you get a question in examination where I say suddenly in PGBP compulsory question puts an adjustment saying online advertisement given to a non-resident without a P without deducting TDS, simply say it's okay. Simply say it's okay. TDS was anyway not applicable. They have not done it. Therefore, there is no problem. You can allow it as deduction. Yes. So it says equalization levy has been discarded within 1st April 2025. Accordingly, any online advertisement charges or any kind of payment for usage of digital space for a person not having a P in India will no longer attract any equalization levy and should not be disallowed under PGBP. I'm going to highlight this 3 more times so that you understand this carefully, because ICI has tested this adjustment many times in the past. In the past, many times ICI has given this adjustment where they'll come and say a company is taking online advertisement spaces and has not deducted equalization levy. Until last year, you were disallowing it. In the current year, if you get the same adjustment, simply say ignore. Simply say ignore. Please don't deduct TDS. 2 conditions to be satisfied. It should be for online advertisement or digital space, and second is it should be paid to a non-resident not having a P in India. Very critical. If it is a resident in India, people, then in that case a conversation of 194J anyway will come into picture. Yes. So if it's going to be 194J, then anyway TDS was applicable. Focus on the word non-resident. A non-resident should be the one who should be receiving this payment. If that is the case, equalization levy will not apply. TDS was anyway not applicable, and therefore TDS amount will be 0, equalization amount will be 0, PGBP adjustment will be 0. Clear? Yes? Good. Amazing. With just 1.5 hours, people, we are done with what is your CA final direct tax amendments. If you notice by direct tax amendments itself, people, there are no critical amendments that you have to keep in mind. One critical amendments, if I have to mark this for you very, very quickly so that you can take note of it, is the amendments relating to section 115 BAC. This is going to be tested for a double taxation relief for sure. Yes, so keep this double taxation relief amendment in mind. Second amendment is going to be somewhere around your TDS. Obviously, I'm not going to question on it. Amalgamation we've already marked as important. Amendment very, very critical. Then you have your non-profit organizations might not come. Your specified persons is something which I am really expecting to be important. Yes, you might get a question on this specified personhood amendment. Keep that in mind. Yes, business trust and all, you will already be handle of people. TDS is the most critical amendment chapter, so keep TDS itself in mind. TDS, TCS obviously both are getting covered accordingly. Your updated return of 48 months will, again, my gut feeling, if you come and ask me, may not be tested in May, but will probably get tested in September. Based on last year's experience, I can tell you, maybe May will not be the amendment year, but September will be the amendment period. So therefore, keep it for September period. Assessment proceedings are great. Search and seizure and all is okay. Transfer pricing is fine. Your presumptive taxation will come as an MCQ question. Yes, your electronic facility has come in. Last year also when cruise ship was there, they gave it twice. It came in both, I think, May and September, or September, January, it came in twice. So therefore, you will get a question on this in examination as well. Keep that in mind. Penalties and all is fine. Reporting is fine. Equalization levy, keep this in mind for PGBP chapter. This is all that you have to read for your finals, people, which means no extra effort required than what you already have done. CA final DT is becoming easier. Last year also we had some weird issues we had, and therefore we used to come and say this you have to keep in mind, this you have to keep in mind before 23rd July, after 23rd July. TDS mein there was after October, before October. This time's paper does not have any complications. All errors have been rectified, all mistakes have been taken care of, all issues have been sorted, which means you just have to read the subject properly and you will clear the examinations. That is how CA final has been prepared for your examinations, people, and I'm sure you're going to do an amazing job. I hope this video helps you to that extent. If you have your other friends who are writing CA final examinations and are struggling for your upcoming attempts, this video is for them, so please do share it with them as well so that they can take the maximum amount of benefit. I'm here only to reach out to most of the people to make sure that you clear your CA final examination with flying colors, and I can probably take a small credit out of it. Yes, with that intention is what I would like to clear this video for all of you. We will come back soon with a lot of revision videos which I'm planning. There are some exciting videos coming up on the revision series with marathon series and a lot of more things that we'll be discussing from an examination perspective. So yes, watch out for the channel. You're going to have some amazing content coming in the subsequent days. Until that video comes in for you and you're getting glued to the videos, I am taking a leave for today. I will see you all very soon with the next set of videos. Until then, great learning to all of you. Have a wonderful day ahead. Take care. Bye bye.